good morning. This is Remon Vos speaking, CEO at CTP, with Maarten and Richard speaking later about the 2022 results. And to start with, 1.9 million square meter of leases signed last year at 6.5% above ERV. So we have done better than we thought last year on signing leases at higher rents per square meter. Earnings per share, 61 cents per share, which is 26% more than last year. And dividend of 45 cents per share, which is up 29% year on year. So we have had a good year last year, 2022. Let me talk to you about our businesses. We like to divide that in three activities. The operator, the part of our business who runs the portfolio, income producing, all the buildings which we have built over the past 22 years, the operator. The developer, building properties, and the energy business is the third part of our business. Let me start with the operator. Quite good, 10.5 million square meter of GLA, gross lettable area, last year, with strong like-for-like rental growth of around 4.5%, which means that on a 12-month term, we would now collect 590 million euro, which is 35% up year on year. And obviously this rental income creates a strong cash flow with around 94-95% occupancy, in line with our target. We like to keep some of the units open here and there for new tenants to move in. We have been able to collect 99.7% of all the rent. So no bad debt, no surprises, very stable long-term tenants, more than 1,000 different companies, residents as we call them, in our parks. Companies involved in a variety of different businesses, multinationals, but also SMEs, involved in logistics, e-commerce, manufacturing, R&D, very diverse and very strong, and a lot of potential among existing tenants to grow with us into new markets, take more space, or to grow in the places where they are active. Now, that is with respect to the operator. We jump to the second activity, the developer. 2022 was a great year, a big year, a busy year, with more than 1 million square meter of space delivered and completed at 10.1% yield on cost. So the guys at the procurement team, the construction managers, have been busy. We have seen construction costs come down a little bit. When the market returns and remained strong, we decided to proceed full speed with our projects at a lower construction cost. And also that helps us to hit the yield on cost target, or maybe even exceed the 10% mark. The rental growth helps us a lot. I mentioned earlier that we've done deals at 6.5% above ERV, and we continue to see that, so do deals at higher rents. And we are not done yet with all the construction work, because we have another 20.3 million square meter of land, land bank, mostly land within existing business parks, where we have infrastructure and permits to build new property. Sometimes for existing clients, but also more and more new clients. We used to do 80% of all our business for existing clients, but now also we have been able to attract new companies to become our tenants, which is important. So in 2023, that means that we target to complete the at least same amount of space as we did in 2022, but likely much more, with approximately 1.7 million square meter now under construction, with most of that will be completed in 2023. Being our own general contractor, in-house construction management capacities, this helps us, gives a lot of flexibility, make sure that we can start on site and we decide when to complete, and this is when the demand is there. So very flexible, we can do modifications, adjustments to the properties while building the properties for our clients. At completion, we believe that we're going to hit 80-90% pre-let. Some of the properties are already leased and we are building them for clients. Others are being built on a speculative basis. Last but not least, very important part of our business and becoming more important is the energy business. So an update before I hand over to Richard. We have done local distribution networks. That means we own the cables, the transformers in our business parks. But also we have installed rooftop solar plants in the past, which perform quite well. And we have decided to make that bigger. Currently have 38 megawatt installed. And we have just started to add another 100 megawatt during 2023. That means that CTP will continue to install rooftop solar plants at the parks and the properties we own. So adding solar panels on the rooftop, create energy and sell that within the park or onto the public grid. Sometimes we store energy with batteries and sell it to the tenants when the price is right and when the demand is there. So that is what we continue to focus on more. We have appointed people who are very much specialized in the energy business and continue to make that an important part of CTP. Much appreciated by the tenants as well, obviously, and we work closely with them together to grow this business, and at the same time also this will help the results of CTP. CTP remains market leader in most of the Central European countries, home market Czech Republic, but also Slovakia, Hungary, and very active at the moment in Poland with many projects under construction where we see a lot of demand. Being at home in Central Europe is a significant advantage. We've been here for more than 20 years and we now clearly see signs of companies bringing activity to Central Europe or keeping activity here. Asia and other places no longer the preferred option for many reasons. So we call that nearshoring or friendshoring in Europe for Europe. And we see fantastic opportunities there going forward. The acquisition of the German portfolio also helps in this respect with German companies where we work in Germany, but also have opportunities to work for them in the region of Central Europe, where we see labor cost at 1/3 of what they are in Western European countries, and higher productivity and a lot of support from local governments. And last but not least, us, CTP, at home in those markets for so many years and continue to grow market share is just a great opportunity. So we look forward very much to the future and with full speed to double the size of the portfolio. Thank you for your attention. I'll hand over to Richard for the numbers and Maarten later on. Thank you very much.
I will now run you through the main financial highlights of 2022. Supported by the positive operational environment, we delivered another set of strong results. On the back of historical low vacancy levels and continued strong tenant demand, we achieved like-for-like rental growth of 4.5%, driven mainly by rent reversion and supported by a small indexation of 1.7% in 2022. As our indexation takes place on the 1st of January, the high inflation that we saw in 2022 will only be reflected in our 2023 like-for-like rental growth. Approximately half of our portfolio is indexed to a consumer price index, and the other half has a fixed rate increase. By the end of 2023, we expect around 70% of our contracts to be linked to inflation. Our net rental income increased significantly to 452 million, up 38.3% year on year, while the next 12 months contracted revenues increased 35% year on year to 589 million euros, and that number has now grown by over 70% in the last 2 years. Company-specific adjusted EPRA earnings increased 42.7% to 265.5 million euros, and our earnings per share increased to 61 cents, outperforming our guidance of 60 cents. We have a robust balance sheet and good access to credit markets, as demonstrated by the different pools of capital we tapped into during 2022. At the end of 2022, we had 1.1 billion euros of liquidity available. Some of our most recent financings included a 175 million euro 7-year secured loan facility in December of last year, and a 95 million euro 7-year secured loan facility last week, both for all-in cost of around 4.25%. We have a strong pipeline for additional financing, with over 400 million euros agreed and to be drawn down over the next weeks. In February, we also increased our RCF to 500 million euros, with a new 3-year maturity and 2 1-year extension options. Our average debt maturity stands at a comfortable 5.7 years. We have a 400 million euro bond maturing in November of this year. That will be repaid from our available cash reserves. Following this, our next material maturity is not until mid-2025. Thanks to our strong cash-generating portfolio, we have a healthy interest coverage ratio of 4.6 times, while our future forward-looking ICR, assuming annualized income for our deliveries, will come to 5.6 times. Our loan-to-value ratio stood at 45%. This is fully in line with our 40 to 45% target range. We continue to deem that to be appropriate, given the higher yielding nature of our portfolio. I'll now hand over to Maarten to give you some more details on revaluations.
The gross asset value of our portfolio came to 11.5 billion euro, up 35.8% compared to 2021 on the back of development completions, positive revaluations and acquisitions. The positive revaluation in 2022 amounted to 723.6 million euro, mainly driven by the deliveries and the investment properties under development, illustrating the strong profitability of our pipeline. The valuations of our standing assets held up well, despite the negative like-for-like revaluation of minus 0.69% in the second half of the year. On a yearly basis, the standing assets saw a positive revaluation of 246.4 million euro, as the estimated rental growth more than offset the yield widening. 2022 saw a yield widening of 39 basis points in the second half, bringing the reversionary yield to 6.8%, mainly driven by the Czech and German portfolios, while other countries like Romania, Serbia and Hungary saw less yield widening as the yields in those countries were already higher. With larger yield movements in Western European markets, the yield differential between, on one hand, Central and Eastern European and on the other hand, Western European logistics is back to the long-term average. We expect the yield differential to come down further, driven by the higher growth expectations for the Central and Eastern European region. Positive ERV growth going forward, combined with continued tenant demand, driven by the secular growth drivers in the Central and Eastern European region, is expected also to further support valuations. EPRA net tangible assets per share increased from €12.06 as at the 31st of December 2021 to €13.81 at the 31st of December 2022, representing an increase of 14.5%. The increase is mainly driven by the positive revaluation of €1.59, company-specific adjusted earnings per share of 61 cents, partly offset by the dividend of 37 cents.
Looking ahead, we remain bullish on the outcome for CTP, with increasing cash flow, earnings, and dividends. In the market, we see several tailwinds for logistics demand, particularly in our business-smart CEE region, and we believe that we are in the best position to benefit from those. Our pipeline remains highly profitable, and while most of the demand is from existing tenants, we see an increasing share of new international tenants coming to CT Parks. Our in-house skills and our experience allow us to continue to develop at a market-leading double-digit yield on cost, and we further consolidate our position as the market leader in the CEE region. We confirm our guidance for 2022 company-specific adjusted EPRA earnings per share of 72 cents, and we plan to stick to our dividend policy of a 70 to 80% payout ratio. CTP has the team, we have the land bank, we have the deep tenant relations, and we have a strong balance sheet. All of these allow us to deliver on our promises and put us on track to reach our goal of a 20 million square meter portfolio and 1 billion euro of rental income before the end of this decade. Thank you. We now welcome your questions.